Hello everyone, good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier session, we started the discussion in relation to determination of national income under chapter 1, unit 1 of economics for finance, and the objectives of this chapter include national income accounting, which also consists of different concepts of national income as well as measurement of national income in India and certain limitations and challenges in the computation of national income. All of them we are discussing in this unit 1 of chapter 1. And as a part of that, we discussed about what is national income first of all, what is the definition of national income, and why national income accounting is important, what is the significance of national income accounting, or importance or advantages, we can say, of national income accounting, how it will be helpful for the governments, economists and analysts in different perspectives. That is an area which we discussed earlier. Also, the system of national accounts as developed by United Nations was also discussed. Of course, most of the concepts that we are trying to understand in this chapter are in accordance with the prescription of system of national accounts only. But what is that system of national accounts? That is a standard set of recommendations which will give a comprehensive conceptual and accounting framework for the compiling and reporting of macroeconomic statistics and other data, which will be in turn useful for analyzing and evaluating the performance of an economy. So that is a system of national accounts developed by United Nations. And as a part of concepts of national income, what are the concepts of national income? There are three concepts, three dimensions. One is product side, other one is expenditure side, and a third one is income side. Naturally, the product side is based upon production based concept, and expenditure side is based upon the sale of the goods and services, and income side measures the distribution of the sale proceeds to different people who have contributed to the production process. So the entire economy always will be based on these three only. There should be some production of goods and services, and they should be sold, and whatever the sale proceeds received from that sale of goods and services will have to be ultimately distributed to different people. Ultimately, these are the three things: production, sales and distribution. That's what is there in three concepts: product concept, expenditure concept and income concept. That's a very important aspect in understanding the national income concepts. And in the series of various measures expressing national income are macroeconomic aggregates. One of the macroeconomic aggregates which is most popular and in general, that is where the computation will start at a macro level, that is GDP at market prices. And we discussed about what does GDP mean, and that too, when it is expressed at market prices, we have to understand we are talking about the market value of the final economic goods and services. The word gross indicates it is gross of depreciation, and the word domestic indicates we are talking about the domestic territory of a particular country. Within that territory, maybe the same country's nationals might earn some income or add some value, or even foreign companies and foreign nationals can come to this domestic territory and add value. All of that will be added to GDP. And when we say market prices, it is indicating that the valuation happened here at market prices of those final economic goods and services. Final, once again, means not intermediary. Those goods which are finally sold to the ultimate consumers, those are to be only taken, and any intermediate consumption in the production of such final goods has to be reduced from the final total value of the output within the domestic territory related to a particular time period. That is why we can call this as a production concept or value added concept. So this is the product side situation. That is why we call it gross domestic product. And the way we calculate also is in general using value added concept. That means the product side and product concept of national income computation. And what is this value added? It is nothing but the contribution of labor and capital to the production process. And intermediate consumption always has to be excluded from the GDP because that amounts to double counting. It should not be included in GDP. Only the final goods and services value has to be considered. So that is a point to be noted. And difference between intermediate goods and final goods is an important question and concept to understand. And while computing GDP, only the final goods value is included. And in arriving that, whatever the value of the goods that are consumed in the production process has to be excluded. That is the very crucial concept of intermediate goods and final goods. Also, we discussed about what are economic goods and what are non-economic goods. Economic goods are those which are generated from economic activities, and naturally non-economic goods are those which are generated from non-economic activities. What is the important point here? What is the point of distinction? Main point is exchange. In case of economic goods, there will be an exchange at a market price. In case of non-economic goods and non-economic activities, there will not be any exchange for price. But still goods and services could be still produced. But there may not be any exchange of goods for a price. And non-economic activities could be done maybe because of the hobbies or other love and affection or the general family duties that people can cater to themselves and their families. So those are not economic activities. Their value, first of all, cannot be calculated. Even if it can be calculated also, that should not be included in the GDP. Only the value of economic goods, that to the value of final economic goods is included in GDP calculation that we discussed. And as a separate question, this point can be asked in accordance with the SNA, that is the System of National Accounts. What is production boundary? Production boundary is that which covers the production of almost all the goods and services. So whatever the kind of products or services which fall in the production boundary, they will be taken for the GDP computation. Imagine if some goods or services are falling outside the production boundary, they are not going to be included in GDP computation. But while doing so, clarification has been very clearly given that agriculture, forestry and fishing products which have been produced for own consumption also are included in the production boundary. Though they are not exchanged, though they are not falling in the category of economic goods, still they are included according to SNA. When the System of National Accounts says they have to be included, they are included, that's all. But normal concept is, in general, non-economic goods are not included. But particularly, as according to SNA, the production boundary includes agricultural, forestry and fishing, only those things which have been produced for own consumption. Their value is also included in the production boundary according to SNA. That's an example of production boundary and inclusions in that. Then, are these the only things which are included? Yes, there are so many other things also which are included here. Most important of them are two things. One is capital goods and the second one is inventory investment. Those are also included in GDP in addition to the value of final value of the goods and services which are produced for final consumption. Capital goods are not generally called as final goods. They cannot be because they are used for something else. So capital goods, particularly the capital goods for industrial consumption. Even capital goods can also be for consumers usage, and there could be capital goods which are for industrial usage, like plant and machinery, like as an example as we have taken, like tractors. Tractors are not used by people for traveling. Nobody is going to buy a tractor to go from office to home, but those are used by the farmers mostly. It means those capital goods are useful in some other production process, and final goods is the agricultural produce in that case. So the question comes, can we say these capital goods are intermediate goods and we should not take in GDP? No, that would be wrong. That is why clarification is very clearly given. Capital goods also should be included in the GDP. Same way, inventory investment also, whether it is positive or negative, from the opening stocks to closing stocks, whether there is an increase or decrease, that has to be included. That has to be definitely taken into consideration while computing the GDP. So these 2 points also to be noted very clearly. As per SNA, agriculture, forestry, fishing, which is used for own consumption also is included. That is some special thing. Definitely we have to keep a note of that. And capital goods and inventory investment also have to be included while calculating GDP. Included don't take too literally. For example, if there is inventory investment negative, that means it should be minused. It should be deducted. So don't be with plus, minus, addition, deduction, subtraction type of words. Understand the concept. Included means they should be considered. So if there are capital goods which are produced during the particular year, though they are not for final consumption, still their value is included. It is added to the GDP. First point. Inventory investment, it is plus. That means closing stocks are more than opening stocks. Add them. If closing stock is less than opening stock, deduct them. Simple. So that plus or minus whatever it is, that has to be adjusted to GDP at a broader level. Naturally, these are all macroeconomic concepts. And we also discussed a very important aspect of what are to be excluded from GDP. Of course, intermediate consumption has to be excluded. Transfer payments like freebies given by the government to the public, like pensions, like this unemployment allowance, like that. Those things have to be excluded because they don't add any value. They're just free payments from government to some public, generally the poor and marginalized communities of the public. And financial transactions are not included. They do not add any value specially. That's only just money changing hands, whatever the name you call it. Illegal transactions cannot be included because we don't know them. If we know them, then they are not illegal. And if we know them, then we'll not let that transaction happen, first of all. We means the government. So illegal transactions, value cannot be included in GDP. BADs, those are called. And non-residents' income cannot be added because that has not been earned within the domestic territory. Capital gains cannot be added. Sale of the second-hand goods cannot be added. Windfall gains like lottery, etc. also cannot be added because, again, they do not add any value. No production happened with that. Only certain capital asset is changing hands, or some asset is changing hands from one person to another person, does not add any value to the economy in a particular year. It is only just changing hands from person to person. But if you consider economy as a whole, there is no additional value that has been generated because of these transactions. So these are all excluded from the computation of GDP. And another important aspect of nominal GDP versus real GDP we discussed, very crucial thing, because a lot of times when we see the newspapers and statements, particularly by the politicians and generally, naturally, the ruling party politicians or ministers, they talk about GDP always, but they never tell us whether they are referring to nominal GDP or real GDP. We should understand that. If somebody says our GDP growth rate is going to be 10%, we will be definitely very happy. We will say, oh, what a fantastic growth. No country in the world has that much growth rate. But suddenly if you realize it is actually not a real GDP growth rate, it is only a nominal GDP growth rate which has occurred because of, let us say, devaluation of rupee, then that is not a real growth rate. That does not really add any value to the economy. So the point is, whatever it is, whenever we see things in the newspapers or media, in whatever way it is, social media, about these economic aggregates, macroeconomic aggregates, we have to be very clear. At least as people who understand finance and understand economics, we should be very clear what is it. We should at least have that question to ourselves and get an answer from that data, from the report, from the information that is available to us. Is it nominal? Is it real? When you compare certain two GDP growth rates, let us say, nominal to nominal growth rate comparison makes sense. Nominal to real growth rate comparison does not make sense. So while understanding and interpreting statistics in real life, nothing to do with examination, care has to be taken about what is the indicator we are talking about. This is where the game will be played in general to build a narrative. Whatever the statistics are there, they can be presented in a way whatever the presenter wants. There is a famous saying, statistics can actually prove anything, sometimes truth also. That is the saying. Means what? In general, they are used for actually proving false things. Numbers will show, very good, fantastic numbers will be there. And those are not lies. Those are real. But those can be presented in such a way that a misleading communication is made. That normal people cannot understand anyway. At least finance professionals, finance students should be able to understand that. And that is why nominal and real differentiation is very, very important. nominal GDP is the GDP at current prices. Real GDP is the GDP at constant prices. Constant prices. Of course, in the world comparison, worldwide GDP's comparison, it is called PPP. That is purchasing power parity GDP. In fact, India is already almost second biggest economy in terms of PPP, purchasing power parity, in terms of GDP at constant prices. But current prices, yes, it is not. But in general, whenever the expression is made, in general, again, we cannot be sure. People can do or tell anything. But in general, when GDP is mentioned, that is nominal GDP at current prices. What is nominal GDP? That is the unadjusted GDP. Simply speaking, whichever the year you are taking, let us say 2019-20 GDP you want to calculate. Okay. Take all the value of the goods and services that are produced and rendered during that year, multiply with whatever their market values of that year, you get nominal GDP, that is GDP. That is what we already defined as GDP at market prices. Which market prices? Current market prices. That is why we call it GDP at current prices. That is nominal GDP. No adjustment is done here. Just existing market values of various goods and services is totaled to arrive at nominal GDP. So, in case of nominal GDP comparison from one year to another year, what happens is, even though there is no change in the physical output plus or minus, just because of changes in the prices, this GDP can change. Even though there is no change in the physical output of real goods and services. That is a problem with nominal GDP, because only the inflation can make this nominal GDP either go up or down, not the real actual production, productivity and activity of the country. So what is the solution for it? We cannot say nominal GDP is useless and all. Definitely that is the basic measure that we are calculating. So real GDP is not a calculation directly. It is an expression. It is actually a converted GDP, adjusted GDP. First nominal GDP is calculated, then it is adjusted for inflation, so that expression can happen in the form of real GDP. And how is it adjusted, the real GDP? That has to be adjusted by taking a deflator. And who will determine the deflator? Government. What base year they will take? Who will decide what base year they will take? Government will decide. Ministry of Statistics, etc. They will decide which base year has to be taken. But some base year has to be taken, and from there onwards, all the GDPs and GDP growth rates have to be expressed using the prices of that base year. When we say constant prices, question comes to constant prices of which year? Current prices, there is no problem. Current price of which year? Whichever year for which we are calculating GDP. That is current prices. No problem in that. That is a basic calculation, nominal GDP. But when we calculate real GDP and express it, we are telling they are expressed at constant prices. Prices of which year? That is base year. And what base year? That changes, keeps on changing. Earlier, the base year was 2004-05, later it was changed to 2011-12, and even it is now proposed to be changed from 2011-12 to some other year. Whichever year it is, we'll have to wait and see. But this is only for understanding purposes of what is the difference between nominal GDP and real GDP. Nominal GDP is the unadjusted GDP. Real GDP is the nominal GDP adjusted for inflation. So in case of real GDP, what we will come to know? We'll come to know the real activity that happened during a year. Prices are not the influencers of changes in real GDP. That is why, irrespective of inflation, irrespective of changes in prices, if there is an increase in real GDP, that is a good thing. That means in that year, there has been a better production when compared to the last year. So that is why real GDP is useful basically for comparative purposes, majorly for that. And when we do the comparison, consistency has to be there. That is why we have to take one base year. And this base year should not be ideally changed too frequently, as per many economists. But once again, what is frequently, what is not frequently, that is subject to debate once again. That is not in our hands. Definitely the government will decide what should be the base year, and once base year is decided, what is the deflator can be calculated by the economists who are there in the government. So that is the difference between real GDP and nominal GDP. Because the topic has come, one more point I would like to draw your attention to. A lot of times people talk about GDP 4.2%, GDP 3.2%. That itself is a wrong expression. GDP is not 3.2% or whatever the number it is. GDP growth rate is that. GDP is different. GDP growth rate is different. What are we trying to do here? What is this calculation we are trying to do here? GDP at market prices. Is it growth rates? No. Growth rates comes later. First, we have to calculate GDP and compare the GDP of 1 year with another year. Then you can understand, okay, whether there is a growth or not. For example, just for example, if you take any 2 years here in this graph, is it indicating GDP? No, sir. It is not indicating GDP. It is indicating a percentage of GDP growth rate. GDP is not coming down. People say from here to here, GDP came down. Arre Baba, GDP did not come down. GDP growth rate came down. That means GDP increased. But earlier, how much growth rate at which it was increasing? Nominal growth rate. Let us say around 10%. Around. And now also it is increasing around 8%. That is the point. So, when we say there is a decline in the growth rate, that does not mean GDP has declined. GDP has increased, but increased at a decreasing rate. That is the interpretation we have to be very clear. Lot of times I observe even some of the so-called TV participants, panel discussion participants keep on talking about GDP reduced, GDP reduced. GDP has not reduced. GDP has increased. So far in all these years which are presented here, GDP never reduced. When we can say GDP reduced, then this goes below the zero. That means negative growth. Then only GDP will reduce. But so far it is not the case. Maybe in the year 2020-21 it might happen because of COVID and related economic turmoil. But earlier GDP was increasing only. Growth rate was there. It was positive growth rate only. But the point is that growth rate itself was fluctuating. From 1 year to another year, the growth rate was either increasing or decreasing. So, like that, when we look at the growth rates, almost from here, the growth rates are continuously decreasing. So, they decreased and further decreased and further decreased. And naturally, 1920 onwards also, definitely there is no other option. It is going to be further decrease only. But for the first time, probably, we may go to negative growth rate, which is nothing but really when we say GDP decreased. So the point here to understand is when we listen to news or read papers or when we try to understand and appreciate any economic indicators, we have to be clear what are we talking about. Are we talking about GDP or are we talking about GDP growth rate? GDP is an absolute number. That's an absolute number. Approximately India's GDP is $3.2 trillion. That is an absolute number. GDP growth rate is not an absolute number. It is a percentage. GDP is for a year. $3.2 trillion approximately is for a particular year. Let us say 2019-20. But GDP growth rate is not for a year. It is when compared between 2 years. Then only no growth rate will be there. How can there be a growth or non-growth be decided? When comparison of 2 years at least happens, then only you can say there is a growth rate, positive or negative, or more or less. So the point of absolute numbers and percentage growth, simple mathematical issue, but still care has to be taken in that. GDP is different, GDP growth rate is different. India's GDP earlier was not falling. India's GDP was. Now it is a different story. Both definitely might fall due to act of God. That's a different story. So that is another point to be remembered while understanding these words GDP and GDP growth rates. And GDP also, GDP growth rates also, for computation of real GDP and real GDP growth rates, there has to be a base year, and that base year as of now is 2011-12, which might be changed in future. These are the things which we discussed in the earlier session. Now let us continue with some more economic aggregates, which are measures of economy. So from GDP, now let us move on to GNP. So gross is same, MP is same. But what is changed from domestic? It has become national. So what is the difference between these two? First is GDP, that is gross domestic product. Now GNP means gross national product. What is the difference between these two? That is the difference of net factor income from abroad. So let us first understand the definition of it. Short note question can be asked from any of them. Any of these measures. What is GDP? What is GNP? What is NNP? What is GDP at factor cost? Any of these indicators can be asked as a short note. You should understand the concept of it, and you should be able to explain what it is. You don't need to by heart it, but you should be able to explain it. The meaning of each of these terms. What is gross national product? It is a measure of the market value of, same thing. All final, same thing. Economic goods and services, same thing. Gross of depreciation, same thing. Produced within the domestic territory of a country by normal residents during an accounting year, same thing. Here we stopped earlier for GDP. Up to here it's same, GDP and GNP, same definition, nothing new. But now what happened? Including net factor incomes from abroad. So in other words, GNP is nothing but GDP plus net factor income from abroad. That's it. That is GNP. It is not something new, freshly calculated. It is nothing but GDP plus net factor income from abroad. Okay, once we have this formula, how to calculate GDP? Reverse. GNP minus net factor income from abroad. That's also okay. If you remember one formula, you remember both of them. No need to by heart separately both of them. Just take this net factor income abroad from this side, right side to the left side. Then it becomes minus. So that is not required. Mainly one is enough. Other side is only just to interpret it, enough. But what you should remember definitely from GDP, how to calculate GNP, that is GDP plus net factor income from abroad. So naturally, this gross national product also is evaluated at market prices. So what we are calling it? GDP MP. MP means market prices. So when GDP is calculated at market prices, then you added net factor income from abroad. You got GNP at market prices only. That is the definition and formula of GNP at market prices. So naturally, nothing new in this. Only new is what is this net factor income from abroad. If we know that, automatically we can calculate GNP from GDP. That is the basic point here. So what is this difference between the national and domestic? National and domestic. Earlier we called gross domestic product. Now we are calling it gross national product. What is the difference between these two terms? The difference is something but nothing but net factor income from abroad. That is the difference. So national, we know this already, is nothing but domestic plus net factor income from abroad. Now let us understand the concept of it. What does domestic mean? As we observed earlier, when we say domestic, it was the value addition done in a particular domestic territory only. But when we say national, national refers to the normal residents of a country who may be within or outside the domestic territory of a country. And naturally it is a broader concept when compared to the term domestic, which refers to only domestic territory of the country. And if you remember, NRI's income was, NRI's value addition was not included in GDP calculation. But now the question comes, what about GNP calculation? Will that be included? Answer is yes. Because we are not talking about here domestic territory. We are talking about the people of a country, Indians let us call. Indians and Indian companies. Whatever they are earning within or outside the domestic territory of a country is called as gross national product. That is national. Domestic means whatever the production happens within the domestic territory of a country, within the land of India, within the boundaries of India, The domestic territory of India, whatever happens, that is GDP. And in case of GNP, when we say national, it is not just the domestic territory. It is even the value addition done by our people abroad also. Our NRIs, non-resident Indians working elsewhere, their value addition is also included in where? In the national concept. For example, look at this example. Profits earned by in India by an ex company which is a foreign owned firm. Like say for example Kia Motors earned some profits in India. It manufactured in India, it sold in India and exported goods from India to elsewhere. Whatever happened, but the profits are earned ultimately by a foreign owned firm. Would they be included in GDP as we discussed earlier? Yes, they will be included in GDP. But would they be included in GNP? Answer is now no. Even though the profits are earned within the domestic territory, they are not earned by Indian nationals. It is not an Indian company. So here, they will not be included in GNP. Same way, similarly, profits earned by company Y, an Indian company, in UK. Let us say an Indian company has earned profits in other country like UK. Would we include them in the computation of GDP? Answer is no, we will not. Why? Because it was not earned in the domestic territory of India. But would we include them in the computation of GNP? Yes, because that profit is earned by an Indian company. So simple logic. National is about a nationality. Domestic is about a geographical area of a country. National is about whatever the profits and whatever the value addition done by Indians and Indian companies, Indian firms, whether that happened in India or abroad, it doesn't matter. That all will be included in GNP, only Indians. So even though some foreign companies add value in India, in the domestic territory of India, that will not be included in GNP. That is the concept of national. National is different, domestic is different. By the way, don't apply these terms everywhere, wherever, whenever, under whichever context you want. This is only for this purpose. Only for this purpose, this has to be understood. When you say GDP, we are talking domestic. When you say GNP, we are talking about national. National means the value addition done by Indians and Indian organizations anywhere in the world, doesn't matter. That is all national for India. Then what is domestic for India? Irrespective of whoever that added value, whatever value added within the domestic territory of India, the geography of India, that is called GDP of India. In that, maybe even the value added by foreign firms also could be included. Let us say we are talking about Make in India. We are welcoming many foreign companies to come to India and invest and do their production or service operations in India. There are so many foreign companies which do that. So, are they all included in GDP? Answer is yes, they are. But are they included in GNP? Answer is no, because they are not Indian companies, they are foreign companies. Same way, Indian nationals and Indian national companies earning money abroad, they will not be included in GDP, but they will be included in GNP. That difference has to be very clear, and that difference is what is called as the net factor income from abroad. That is the net factor income from abroad. What is this net factor income from abroad? That is the difference between aggregate amount that a country's citizens and companies earn abroad. So let us say our Indian companies and Indian nationals are earning some money, X money, in outside India, minus the aggregate amount that foreign citizens and overseas companies earn in that country. Same way, foreign companies and foreign nationals might earn income in India. Let us say Y. Then X minus Y is what is net factor income from abroad. In other words, what our people when I say Indians and Indian companies, what our people earn outside India minus what outsiders will earn in India. That difference is net factor income from abroad. Sir, could this be positive or negative? Both are possible. If X is greater than Y, then net factor income from abroad is positive. If X is less than Y, then net factor income from abroad is negative. When can we say net factor income from abroad is positive? Means our people are earning more outside India than outsiders are earning in India. Then that's a good thing actually. That's a positive thing. So net factor income from abroad is positive. On the other side, if Y is more than X, which means foreign companies and foreigners are earning more in India than our people are earning outside India, then NFIA will be negative. Naturally, depending upon whether NFIA is positive or negative, GDP and GNP will also change. Will GNP be more than GDP? Possible. When the net factor income from abroad is positive, then only the GNP would be greater than GDP. What if the net factor income from abroad is negative? Then naturally GNP will be less than GDP. So simply speaking, net factor income from abroad is nothing but the difference between national and domestic. That's all. National and domestic difference is net factor income from abroad. National is equal to domestic plus net factor income from abroad. Every time we cannot call net factor income from abroad, so we are going to call it as NFII, but in the exam you have to write the full form. So NFII IA is the difference between national and domestic. In other words, aggregate amount of countries' citizens and companies earn abroad minus aggregate amount that foreign citizens and overseas companies earn in that country. That's called NFIA. If it is positive, then GNP would be more than GDP. If it is negative, then GNP would be less than GDP. That's it. That is the important difference between GDP and GNP. And that is the difference between national and domestic. And that difference is net factor income from abroad. Now let us take it further. Now we had the gross things, GDP and GNP. Now the gross thing, let us make it net. We know this already, just simple logic. What is the difference between gross and net? Depreciation, that's all. When you say NDP, that is net domestic product, of course at market prices only. So all the definition will be same. Instead of gross of depreciation, we will say net of depreciation, that's it. So what is net domestic product at market prices? Same thing. It is a measure of the market value of all final economic goods and services produced within the domestic territory of a country by its normal residents and non-residents also naturally within the domestic territory. We are talking domestic here, not national. So domestic territory, whether residents or non-residents, whatever they are producing within the domestic territory of a country in an accounting year, market value of all those final economic goods and services will be added, less depreciation, that will give NDP. If you don't deduct depreciation, that will be GDP. Simple. So what is the difference between gross and net? Simply depreciation. What is depreciation? That is nothing but the portion of the capital stock that is used up in the process of production. Simply that is called depreciation. That must be subtracted from the final sales value because depreciation represents the capital consumption. That is a word economically used for depreciation. Depreciation is an accounting word mostly. So capital consumption, when you see, simply have to understand we are talking about depreciation. Some capital expenditure happened and some asset is purchased. That's all. Is that going to be like that only forever? No. Except land, all assets are going to be consumed. They are going to be at least a portion of them consumed during a year. Should that be accounted for? Yes. When we say net, when we say gross, we don't worry about that depreciation. When we say net, then depreciation has to be deducted from the gross domestic product in order to arrive at net domestic product at market prices. So simply speaking, difference between gross and net is depreciation. These things you have to be very careful. Difference between national and domestic is what? NFIA. Difference between real and nominal is what? Inflation. Difference between gross and net is what? Depreciation. Simple. Once we understand that, easily we can calculate one thing and use it for the computation of something else. So to sum it up, simply speaking, gross is nothing but net plus depreciation, or net is nothing but gross minus depreciation. Depreciation is also called as capital consumption. in a particular accounting year. That is net domestic product at market prices. Now let us make it further. Domestic can become national. So net national product at market prices. So you know that already. What is the difference between domestic and national? That is net factor income from abroad. So if you already have net domestic product, already, if you have, then just add net factor income from abroad, you will get net national product. So net national product is nothing but a measure of market value of all final economic goods and services produced by normal residents within the domestic territory of a country, including net factor income from abroad during an accounting year, excluding depreciation. Why excluding depreciation? Because we are talking about net. Why including net factor income from abroad? Because we are talking it national. That's all. So if you have one thing, we should be able to come out with other thing. Let us say if we have GDP at market prices and we want to directly know net national product at market prices. First we have to convert something to something. Let us say first we will convert domestic to national. For that what we should do? We have to add net factor income from abroad to GDP. All things cannot be done at one shot, one by one. So D to be converted to N means add net factor income from abroad to GDP. Then G to be converted to N, that is now net. That for that deduct depreciation. Simple. Same way, if you already have gross national product if you already have, you want net national product. Only one thing to be converted, G to N. Only one thing. Which means only one thing to be converted means what is the difference between gross and net? Depreciation. So GNP minus depreciation will give you that. No need to by heart this formula. If you understand conceptually difference between gross and net, difference between domestic and national, automatically you can do it easier without by hearting this formula. But yes, you should definitely use correct formula for computation using the correct concepts. Same way in the second one, net national product, net domestic product. Here also only one thing to be changed. First one is N, second one is N also. So there is no problem here. Only national to be, domestic to be changed to national. How can we do that? Add net factor income from abroad. But in the third case, G has to be changed to N. This D has to be also changed to N. How to change G to N? Gross to net, deduct depreciation. I'll do it first, sir, no problem. Plus or minus, how does it matter? You know that. Whichever one can be done first. Ultimately, the final answer should be correct. Then domestic I want to convert to national. So naturally you have to add net factor income from abroad. So from one thing, every other thing can be and should be calculated. We should be able to calculate from any one aspect that is given in the question. By doing certain adjustments, we should be able to compute something else which is asked in the question. Now so far, all the things that we talked about, so many things we talked about. What are those? GDP at market prices, GNP at market prices, NDP at market prices, NNP at market prices, and of course one expression of GDP nominal and GDP real. That is different actually from this. Normally we all are talking about nominal only. All these things which are computed, they are computed for a particular year, means they are computed at the prices of that year only. But real things come only for expression and comparative purposes. So that is completely separate from this series. That's an important concept, but it is not included in the same series we are talking about. What is the series of various indicators that we have been calculating and trying to understand so far? GDP-MP, GNP-MP, NDP-MP, and NNP-MP. These are the four things. But all of them have one thing in common, that is MP. MP means not member of parliament. That is market prices. All of them are calculated at market value. For all the definitions, this word is common. They are computed at market value. So this is the expression that normally we do, at market value. When you say GDP MP, or GNP MP, NDP MP, NNP MP, all of them clearly we have to indicate they are at market prices, market value, prevailing in that year for which these indicators are calculated. Done. Now let us continue this to some other very important aspect. Factor cost. Market price is one expression that we have already known. Now, factor cost is something at which GDP, GNP, all the four things, whatever we have so far GDP, and then GNP, then we have NDP and NNP. All of them can be expressed at market prices, which we already know. Now all of them can be expressed at factor cost also. Factor cost also is possible. That is another expression. Now the point comes, what is this difference between market prices and factor cost? Very important difference between market price and factor cost. Factor cost means cost. Market price includes naturally profit, and most importantly, the difference between these two is market price includes indirect taxes. So simply the market value of the goods and services will include indirect taxes in addition to the factor cost. Do these indirect taxes really add any value to the production process? Answer is no. But all the others have added value, including profit actually. Why? Because that profit is the return for the person who has invested the money. That is also going to a person, the investor, the capitalist, the industrialist, the businessman, whoever it may be. So that is also part of the entire value of this particular commodity. So a particular commodity will have so many things. It will have the cost of materials. It will have the cost of labor that is paid. It will have the cost of interest, rent, capital. So material will be there, labor will be there. Of course, you want to say overheads also, they will be there. Interest will be there, rent will be there, profit also will be there. So interest, rent, profit, these are the things which will go to the providers of finance and assets like land and property. Materials will go to the suppliers, whoever has supplied, and labor will go to the labor who have worked for this production process. In addition to this, there will be taxes. Which type of taxes? Indirect taxes. Then after adding all these things only, the market price will come. Market price is inclusive of indirect taxes. Now the point is, okay, normally when you express GDP at market prices, we don't worry about these indirect taxes and all. But if we want to express the GDP, GNP, NDP, NNP at factor cost, what should we do? What should we do? Simply deduct these taxes and only take the remaining thing. So whatever the market prices is there, whichever the expression from market prices is there, deduct indirect taxes from that, you will get the same thing expression at at factor cost. You want to say, let us say GDP at factor cost. Simple. GDP at market prices minus indirect taxes. Net taxes, let us say. We'll come to that net point also. Why is that? Minus indirect taxes. Same way, GNP at market prices we know. We want to know factor cost. Okay. GNP at market prices minus net indirect taxes. Whatever this is, whichever the one we want to compute. Whenever we want to compute something at factor cost, simply that is nothing but market price minus net indirect taxes. What is net indirect taxes? Definitely, that is the difference between indirect taxes as well as subsidies that can be given by the government. So taxes are something which will add to the cost. No? Whereas if there are subsidies that are given by the government, they would have reduced the cost. They would have reduced the market value already. So market value, if at all we want to find out, that will be cost plus the taxes minus subsidies, right? Now we want reverse. We want factor cost. What should we do? Reverse. Market price plus the subsidies minus indirect taxes. So the difference between indirect taxes and subsidies is called as net indirect taxes. Of course, in general, country like India, this is positive only. Indirect taxes are more than subsidies. Government subsidies are relatively lesser and lesser. They are becoming lesser and lesser also. So doesn't matter the facts of numbers, but ultimately this net indirect taxes is the difference between indirect taxes and subsidies. So if you say market price minus of net indirect taxes, market price minus of net indirect taxes means minus of indirect taxes, minus of minus becomes plus. That is the formula. Simply market price minus indirect taxes plus subsidies. That will give you factor cost if you already have the market price. Of course, the primary data that is collected is always market price, and that too naturally for GDP in general. So what should happen, the sequence if you see, First, we have to take gross domestic product, the market value of all the goods and services produced within the domestic territory of the country in a particular year at market prices. First, you calculate that. Then, add net to factor income from abroad to that, you will get GNP. Then, deduct depreciation from that, you get NNP. All of them are at market prices. Then, deduct net indirect taxes from any of them, you will get the same things at factor cost. Now the question comes, what are these two things? Indirect taxes and subsidies. See, subsidies definitely will reduce the market price. Indirect taxes will increase the market price. That's common sense. What types of indirect taxes could be there? This is an important short note question. Of course, all questions are short note questions here in this paper. Product taxes and taxes on production. These are all called as indirect taxes. Then what is the difference between product taxes and taxes on production? Important question. Distinguish between product taxes and taxes on production. Product taxes simply are those type of taxes, indirect taxes naturally, like excise duties, though excise duty is not there on most of the commodities in India. Already GST has replaced it, but still there are some goods on which excise duty still exists. So those places, excise duties, customs, sales tax, service tax is not there anymore. Only for example, GST is the biggest example of product taxes levied by government on the goods and services. GST itself is the name itself indicates goods and services tax. That is a product tax. Product, once again, you should not think only about physical commodity. Always in economics, whenever we say product, production, we have to understand that includes goods also, services also. That clarity should every time be there. Always be there. So we should not take the word product or production in a narrow sense. We have to take that in a broader sense. Okay, keeping that apart, all these type of taxes are called product taxes, and naturally those are indirect taxes. And what is the difference? What is the specialty of these type of taxes? They are related to the quantum of production. They are related to the quantum of production, sale or level of activity. For example, if a particular manufacturer has manufactured and sold more, he will pay more GST. Another manufacturer has manufactured and sold less, he will pay less GST. Simple. Is that depending upon the quantum of production or level of activity or not? Yes, it is. That's completely related to the volume of production, volume and quantity of production and sale. Those are called product taxes, which are more popular, and those are the ones which we normally call as indirect taxes in general sense. But are they the only taxes? Are they the only taxes? Generally, no. Usually the state governments and local authorities will have certain types of taxes which are called as taxes on production. Like what? Factory license fees. License fees will not be generally based on the volume of production. It will be fixed. Okay, boss, your factory is located in 44,000 square feet. Per square feet this much, that's all. Maybe generally that is based on area. For even commercial operations, commercial license is required. For any shop, small shop also, for example, the municipality will collect some license fees. Is that based upon the volume? No, it is not based upon volume. It is generally fixed on some basis, usually on the basis of area. Not necessarily, but usually. That is an example of taxes on production. Same way the taxes to be paid to the local authorities like property tax, pollution tax, etc. These are called taxes on production. But what is the difference between them and product taxes? Product taxes were based on the quantum of production or sale or level of activity, whereas taxes on production are not related to the quantum of production. They are unrelated to the quantum of production. Whether you produce or don't produce, you produced more or produced less, these taxes on production will not be changing. They will be more or less fixed. So tax on production can be somewhere type of fixed taxes. Product taxes are variable taxes, but both of them are indirect taxes. Whatever the indirect tax is, simply the logic of indirect tax is always that the burden, final burden of them can be passed on to the consumer or not. Yes, means it is indirect tax. Both are indirect taxes. Though popularly, it is indirect taxes means nowadays only GST and customs duty. Remaining all the state government level indirect taxes are almost extinct, except on very few commodities like petroleum products. All the other taxes have been subsumed by GST, as you might be already aware of. So product taxes are those which are related to the quantum of production. Taxes on production are those which are unrelated to the quantum of production. That is the difference. And you should give some of these examples for a small 2 or 3 marks question, which is very important, possible question. Distinction between product taxes and taxes on production. And both of them are called indirect taxes. And those should be reduced from the market price in order to arrive at factor cost. If there are any government subsidies to the production process, people will look at subsidies and transfer payments and mix them up. No, subsidies are different, transfer payments are different. Subsidies, what we are talking about, the subsidies given to the business sector, not to the individuals. Let us say government is giving a free ration, food subsidy it is called. Is that the subsidy we are talking? No, that is not the subsidy. That is a kind of transfer payment. But here, subsidies, here we are talking about those will give a reduction to the market price to the sector which is business sector. For example, government gives a subsidy if you purchase some alternative electricity generation equipment, something like solar energy or something like wind energy. If you want to purchase a windmill which produces electricity, government will give some subsidy. That is the subsidy we are talking. That has to be added to market price in order to get factor cost, because the market price of that windmill is actually lower already. Why is it lower? Because of the government subsidy that has to be increased with the subsidy that has been given by government. So that it becomes factor cost. That is the subsidy we are talking. Same way, let us say the electric vehicles. If you buy any electric vehicle, a bike or electric car, fully electric car, then government will give some subsidy on that. So what happened? Because of that, the market price of that electric car has reduced. Ideally, let us say a particular car, electric car is supposed to be 25 lakhs in the market. That is the market price normally. But the government said that I will give 5 lakhs as subsidy. So market price is only 20 lakhs. So while calculating GDP already, we used 20 lakhs because that was the one at which this car is sold actually in the market. But is it real? Is it correct? No, it is not correct. Why? Because the real cost of that vehicle is not 20 lakhs, it is 25 lakhs. Because of the government's subsidy, it has reduced from 25 to 20. Now we have to increase it back by adding the subsidy to the market price so that we get factor cost. So simply speaking, the factor cost, any time factor cost is nothing but whatever we calculated at market prices plus subsidies minus indirect taxes like product taxes and taxes on production. Now, that concludes most of the points related to computational aspects of these economic aggregates. So, if at all we want to know the gross domestic product at factor cost, we know already how to calculate GDP at market prices. Now, if we want to calculate gross domestic product at factor cost, naturally you have to take GDP at market prices minus indirect taxes plus subsidies. That will give GDP at factor cost. This is the value added concept or production concept so far we are looking at. Now let us introduce something else. This is something else. This is a different concept. This concept is called as income concept. So for all the things we talked about is value added, market value of the goods and services produced during an accounting year is the word we have been using all so far. That all was from the production point of view. Now, if the same gross domestic product at a factor cost has to be calculated, at factor cost has to be calculated from income concept, income of different types of people in the country, then how it can be calculated. This is the another formula, new formula completely, but from not production side, but from income side. How to calculate that? Compensation of employees, that is the wages and salaries earned by the people who are working class, plus operating surplus, which includes rent, interest and profit. Rent will be for the person landlord, interest will be for the person who has provided the capital, and profit is also to the person who is an entrepreneur and person who has provided the capital. So rent, interest, profit plus wages is what income of the people is, right? Is there any other income that people will earn in the country? Anybody? Nothing else. Ultimately, this will be the income. Compensation of the employees. And surplus. Surplus, definitely yes. Surplus of what? In the form of either rent or interest or profit or all the three together. And another important aspect, which is a short note question by itself, is mixed income of self-employed. So the first two things may be easy to calculate, compensation and rent, interest, profit. Let us say there is a company, say something like a big company like Reliance Industries Limited. So what is the total profit that the company has earned, and what is the total compensation that the employees of this company have earned, and what is the rent, if at all, any provider of property to this company has earned, and what is the interest that the providers of finance to this company have earned. All of them put together is simply the incomes of the people who are connected with that company, right? And like this, one company we are talking. Imagine all the businesses in the country, all of them, all individuals and businesses in the country. They will have incomes, definitely. So ultimately, the accounting of this income will happen at one point or another point. There will be ultimately people who will earn income in the form of employee compensation, most of that. And there will be other things like profit, rent and interest. These are the things which can be segregated easily, relatively easily, particularly when we are talking at a organized sector, which is like companies, etc. But what about self-employed people? Let us say there is a doctor or a chartered accountant or a lawyer, a professional is there. So for our convenience purposes, let us say there is a chartered accountant, okay, where we will include his income. He is doing his practice. Let us say, imagine he is doing practice at his own home. Is he going to pay any rent to himself? No. And while starting his practice, he has invested some money, let us say 10 lakhs rupees for the furniture, interior, etc. of the office. Is he going to pay interest to himself? No. Okay. Is he going to pay himself salary? No. So what is it that this person is earning? He is earning something. Can we call it profit only? Exactly no. Can we call it interest only? Exactly no. Can we call it rent only? No. Can we call it salary only? No. That is why we call it a mixed income. We are not calling anything actually. We don't have to and we cannot segregate. Whatever the income this particular individual chartered accountant or for that matter any self-employed person is earning, it is difficult to segregate what is the nature of that income. So we don't want to segregate. We don't need to segregate. So simply what we are calling it? We are calling it as mixed income of self-employed. Add that also. Add that also. And add depreciation also. Why? Sir, why add depreciation? Because we are talking about gross. When you say gross, it should be inclusive of depreciation, gross of depreciation. That is why add that also. That is the formula for calculating GDP at factor cost, not at market prices. Because we are talking about factors only. Compensation of employees is a factor called labor, right? Rent is a factor called land, interest is a factor called capital, profit also is a factor called capital and entrepreneurship. So all these factors of production have some return to themselves. That is why those are all incomes for them. And naturally those are the factor costs which are incurred in the production process during a particular year. So those are all added to get GDP at factor cost. Compensation of employees, rent, interest, profit, mixed income of self-employed plus depreciation. Why? Because gross. Sir, what if I want to calculate net domestic product? Then don't add depreciation. Simple. That's simple. Because what is the difference between gross and net? Depreciation only. If you added depreciation here, you got gross. Don't add depreciation. You got net. So net domestic product at factor cost will be what? Other than depreciation only will be that. Naturally. Same thing is mentioned in the next slide. What is net domestic product at factor cost? Whatever the net domestic product at market prices minus net indirect taxes. Always the difference between market prices and factor cost, whatever it is. Difference between these two is what? Net indirect taxes. That is the difference always. Why we say net indirect taxes? That is the difference between indirect taxes and subsidies. So that is market prices and factor cost. We know that already. And same way, if you want to know the net domestic product at factor cost from income method, this is product method, production model. This is income method. Under this what? Same. Compensation of employees, operating surplus, mixed income of self-employed. Can you observe something is missing here? What is missing is depreciation. Why is it missing? Because we are calling it as net. Net means without depreciation being added here in this case. If already market prices you are taking after deducting depreciation, that is the difference. When market prices are taken, already that is gross. From that, if you deduct depreciation, you get net. But here, we are not going from market values. Directly, we are getting the factor cost in the form of their wages, rent, interest, profit, and mixed incomes. So that is why, after doing all these addition from the income point of view, adding depreciation will give you GDP at factor cost, whereas without adding depreciation, you will get NDP at factor cost. So GDP at factor cost, NDP at factor cost. Now, sir, I want to know GNP, let us say, at factor cost. Simple. Add net factor income from abroad to GDP at factor cost. So GDP factor cost and GNP at factor cost. Naturally, anything between D and N difference there, domestic and national, will be net factor income from abroad. These differences is the only thing that we should understand very clearly. Difference between gross and net is depreciation. Difference between domestic and national is NFIA. Difference between market prices and factor cost is net indirect taxes. Difference between real and nominal is inflation. That's all. These are conceptual things that we should remember. Then naturally the formula can be also easily understood and remembered, which can be applied in solving the problems related to this topic. Now this is another question that can be expected. What is this mixed income of self-employed? Already we discussed this. The same thing has been elaborated here for a short note question. Mixed income of self-employed refers to the surplus or deficit amount which is earned from the production process by the enterprises which are not incorporated. So we are talking about normally the unorganized sector, we can say. Individuals doing practice or professionals, artists like that. Not incorporated, not established, not registered type of enterprises. Whatever the profits, surplus or deficit they earn, that is called a mixed income of self-employed. Simply when we say this is a mixed income of self-employed, when it is difficult to segregate, whenever it is difficult to separate, then mixed income is what we call it. So mixed income includes all those incomes which are difficult to separate or segregate. Means we cannot call it wages also, we cannot call it interest, profit or rent also. If that is the segregation which is becoming difficult, simply we call it mixed income of self-employed. For example, as we have taken earlier of a chartered accountant example, similarly, for any self-employed person, it is difficult to distinguish what is the labor income from the capital income. Why? Because he or she, that self-employed person, provides both labor services also and capital also. So whatever the profit that the person, self-employed person earns, in that how much is towards his labor, how much is towards his value added in the form of work he has performed, or how much is towards the capital that he has provided to this particular profession or business. That is difficult to distinguish, difficult to segregate. That is why we don't segregate. Nobody is telling that you do a great exercise of segregating it. Simply we say, okay, it is mixed income of self-employed. That is also income naturally. In addition to the incomes which are clearly possible to be segregated in the form of wages, rent, interest, profit. So wages, rent, interest, profit, mixed income of self-employed will constitute incomes of various people in a country. Adding all of them will get net domestic product at factor cost. Add depreciation, you get gross domestic product at factor cost. That is a point to be noted. Now, the real final thing has come. This is where we started and this is where computations will end. National income we call it. What is national income? The national income ultimately is this. That is the net national product at factor cost. Net national product at factor cost is called as national income. Now we know each of those words. What is net we know. What is national we know. What is factor cost we know. So what is this? National income. It is the factor income accruing to the normal residents of the country during a year. It is the sum of domestic factor income and net factor income from abroad. Naturally. Why? Because the word used here is NNP, national product, not domestic product. So it should include the domestic factor incomes also the net factor income from abroad. In other words, national income is nothing but the value of factor incomes generated within the country plus a factor income from abroad in a particular accounting year. Simply speaking, this is the formula for national income, which is nothing but NNP at factor cost. How to calculate that? NDP at factor cost plus net factor income from abroad. We get NNP at factor cost. That concludes the discussion on computation of various economic aggregates like GDP, GNP, NDP, NNP, and all the four can be expressed, all of them can be expressed at market prices also, factor cost also. But what is the ultimate thing, final thing, climax is NNP at factor cost. How to get that? NDP at factor cost plus a net factor income from abroad. So within these various economic aggregates, whatever the information is asked and given, we should be able to play with these concepts of national versus domestic, gross versus net, market prices versus factor costs. These are the things required normally. Of course, real nominal is a different discussion altogether. That will not fall in the sequence here. So normal sequence is from one to another, they will keep on just getting added, and there will be a lot of things that will have to be adjusted in order to arrive at this net national product at factor cost. Ultimately, this is the objective. That's what we are calling it as national income, net national product at factor cost. Now, before going to some other aspects, let us say our starting point to here, how the various adjustments can be done. Let us say our starting point is GDP at market prices. That's what is normally going to be computed, right? The data that is available with the government will be GDP at market prices, first of all. From that, how to come to NNP at factor cost. So that is starting point is GDP at market prices. Ending point is NNP at factor cost. Simple. One by one you have to convert. Whichever one you want to convert first, whichever one you want to convert next, that doesn't matter. Let us take one by one. Let us take gross to net. Okay, gross to net. So we have already gross and we need net. Means what? Deduct depreciation first. Then it became net. Then we have domestic to national. How to convert domestic to national? Add net factor income from abroad. You convert it from domestic to national. Then we want to convert market price to factor cost. Market price to factor cost, you have to just deduct net indirect taxes. In other words, deduct indirect taxes, add subsidies. Enough, done. Like this, from anything to anything, we should be able to compute whatever the relationship is. One by one, you have to just convert. And reverse is also possible. If a factor cost is given and if you want to calculate GDP at market prices, still possible. Any question can be asked. Ultimately, the conceptual clarity is required. Gross to net, you want to convert means you have to deduct depreciation. Domestic to national, you want to convert means you have to add net factor income from abroad. And market prices to factor cost, if you want to convert means you have to deduct net indirect taxes. In other words, indirect taxes minus subsidies. That's it. That is the logic we have to clearly understand, than just blindly by hearting these formulae. Formulae are important, but you don't need to by heart them if you understand the concept clearly. Now, after calculating this national income already, then we can find out per capita of any of these things actually. GDP per capita, you can find out NNP, GNP, whatever it is, all the things per capita you can find out. Simply what is per capita income? It can be a short note question as the name itself indicates, and most of us know it even from school days. What is per capita? Per capita is nothing but it is a measure of country's economic output per person. Per capita means per person. How to calculate per capita? Simply divide the country's GDP and divide it by total population. So GDP of the country divided by total population is nothing but GDP per capita. I want GNP per capita, no problem. GNP of the country divided by population. So whatever it is, per capita is always about total divided by number of people in that country, the population of that country. Simple. That is the total population in the denominator always. Numerator could be different according to our requirement. And what is the usefulness of this? Naturally, it will be an indicator for understanding the standard of living of a particular country. And as far as GDP per capita is concerned, India is ranking in the world more than 100 actually. So that means, simply speaking, there are more than 130 countries which are having a better GDP per capita than India. Once again, general knowledge, not useful for exams. Don't write all these things, not required. But definitely that indicates that our GDP per capita is very less, and we can understand that also very easily because our denominator is huge. Our denominator is total population, which is huge. Naturally, the resultant will become lesser and lesser. So approximately, the GDP per capita of India is around $2,000 per year. That is where we are standing, and a lot of countries have much bigger GDP per capita. That indicates that the standard of living is higher in other countries when compared with India. So that is one measure only or indicator only. But is it always true that per capita income is the only measure? Absolutely, answer is wrong. Why? Because see, per capita income is sometimes a deceiving measure also. As I said already, statistics cannot be blindly followed with the numbers. They have to be analyzed and understood. If I say, just for example, the average income of myself and Mukesh Ambani in a year is 500 crores rupees. Let us say. Am I lying? No, sir. Average income of myself and Mukesh Ambani is 500 crores. So do you think I am rich as Mukesh Ambani, or almost equivalent to Mukesh Ambani, or even at least closer to that in crores? Answer is no. But I can say that confidently. I can prove that also. Average income of Mukesh Ambani and myself is 500 crores, or maybe more than that. So the point of expression is, it is average, no? When it is averaged, the average figure will be always misleading. And another example can be taken, like one of the persons, some person wanted to cross a river, okay, and he knows swimming, but his capacity is only that he can swim if the depth of the river is, say, around up to 10-15 feet, not more than that. If the river is much deeper than that, he is not capable person to swim actually. So before jumping into the river, he asked a local person, sir, what is the average depth of this river, or what is the depth of this river? And the local person said, average depth of this river is 6 feet. Then the person was very happy. He just jumped into the river and died after some time. Then people got surprised. They know that this person can easily cross the river if the feet was 6 feet. Then why he died? Because that was average feet, average depth of the river, not the depth of the river. Let us say at one point in the river, the depth was 20 feet, just for example. And at another point, the depth was only 1 feet. And you take an average, it will come only to 10.5 feet. And like this, you take 2, 3, 4 points and you take an average of them. Still, it can be only 6 feet or 5 feet. Average is misleading always. Average will not tell any real indicator of the overall thing that we are looking at. So, if you take GDP per capita, that is also something like an average. That itself may not indicate really the actual position of all the people in the country. If India says we have $2,000 as our GDP per capita, So does it mean everybody in India is earning almost say 1,50,000 rupees a year? No, not necessarily. Maybe a lot of people are earning much less than that, and some people are earning much more than that. But when averaged, that gives an average per capita GDP. So that is an indicator. We cannot say it is a useless indicator, but at the same time, we have to be careful. It is not something that really reflects the ground reality also. So that is per capita income, and don't write all this analysis and explanation in the exam. You have to write what is the technical meaning of per capita income. Enough. Nobody is asking you or explaining, expecting from you any commentary on the economics. That is none of your business. You should not write these things in the exam. When I am explaining, it is only for the purpose of making the understanding of the concepts in a better way. Only for that purpose, explanation is given. I observed a lot of times students write explanations in the exams, not the concepts. That is wrong. You may remember this easier than the concepts because of not working on the reading part and remembering part. But that does not give you marks. That will not give any benefit in the examination. So examination is a different story altogether. Learning process is different. We have to bridge the balance between them always. Always that trade-off is required between these two. Explanations are only for understanding. Examples are only for understanding. Any factual data given to you is only for understanding. That does not mean anything more than that. What is important from examination point of view is what is there on paper, what is visible to you now on the screen. That is what you should write. If the question says what is per capita income, this is what you should write. Per capita income is the GDP per capita, which is a measure of the country's economic output per person. It can be obtained by taking the country's gross domestic product, adjusted by inflation naturally, by the total population. And it serves as an indicator of the standard of living of a country. Enough. 3 marks, 2 marks question. What else you will write more than this? More than enough. That's what you should write. But what I told you about per capita income, about GDP per capita as an indicator, that is only for understanding purposes. Nothing more than that. Now moving ahead to another word, that is personal income. Okay, we have national income already. National income is national income, right? Not individual's income. That is the income of the entire country, let us say. And what was national income? As we already found out, NNP at factor cost. That is net national product at factor cost. That is national income. Then what is personal income? Personal income, is it equal to national income? Is the entire national income coming to the pockets of the persons, individuals in the country? Answer is no, it is not. Why? Because entire amount of the money that is value that is added during the year will not be coming to the pockets of individuals. So we need to understand one thing. National income is something that is the income earned by the factors of production, not received. Earned is different, received is different. I am sure accounting students understand that. So when you say national income, what was that? That was income earned by the factors of production. Then what is personal income? That is something that is received by the factors of production or all the individuals or households during a given period. Ultimately, where the income will go, where the money will go, finally comes to human beings only. No? Whether it goes to Mukesh Ambani or to an auto driver, ultimately money has to go to human beings only. Of course, there will be some money which is kept in the corporations in the form of undistributed profits. Can that be called as personal income? No, it is not, because it does not reach to the individuals or households. But is that part of national income? Yes. Whatever the profit that the corporation has earned during a year is a part of national income, definitely. But is it personal income? Answer is no. It is not personal income, it is only national income. So name itself indicates personal here means individuals or households. Whatever the money actually received by individuals or households during a given period is called as personal income. So it forms the basis for the consumption expenditures naturally. People can spend from this only. No? I have earned so much. What is the use if you did not receive it? What is the use of it? A lot of times, let us say there is an employee working in a company. He did not receive salary for 6 months. Did he earn the salary? Yes, he did. Did he work? Yes, he did. He earned, but he did not receive. Will that be included in national income? Answer is yes. But will that income? Because it did not receive it. So national income is something which is earned by the factors of production, all factors of production. But personal income is only something that is received actually by individuals or households during a given period. And it is the basis for consumption expenditure. So in other words, personal income is nothing but the income actually paid out to the household sector, ultimately, once again, not to the corporates, not to the companies, not to the corporations or business houses or government, to the households, normal, common man, whoever that may be. Household does not mean only poor or somebody, everybody, individuals in the country. For them, what is actually paid out during a year, that is called as personal income. Not necessarily that could have been earned. Sometimes it could have been just paid to them without them being earning it. What are the examples of this personal income? Very classic example of that is transfer payments, like social security benefits, unemployment compensation, welfare payments. We see all these things, old age pensions are given. Or sometimes recently as announced, all the ladies who are having Jan Dhan accounts were given 500 rupees, let us say, in one shot throughout the country. They received 500 rupees in their accounts. Did they earn it? No. Did they receive it? Yes. Is it their personal income? Is it included in the personal income? Yes. But should it be included in national income? No, it should not be. Why? Because it was not earned. It is only a transfer payment from government to public. This is what once again people call freebies. Freebies will be included in the personal income, and as we know already, they will not be included in national income because there is no additional productivity from that. It is just given freely by the governments to the people in the form of transfer payments, like old age pensions, like the pensions for widows or pension for ladies, or sometimes unemployment benefits, unemployment allowance or compensation. These are all part of amounts received by people but not actually earned by them. So they can be called personal income, but they cannot be called as national income. That is one part of personal income. And other things are also there which should not be called as personal income, though they are forming part of national income. What are those? Like, for example, individuals contribute income which they do not actually receive. For example, undistributed corporate profits. Corporate profits are earned, but are they distributed? No. If they are lying in the reserves and surpluses of the balance sheets of the companies, what did the individuals in the country receive? Nothing they received. So, should it be part of personal income? Answer is no. Same way, contribution of the employers to the social security. In India, social security is a provident fund, for example, or a pension scheme to which the employer has contributed on behalf of employee. Once again, did the employee earn it? Can it be called as employee benefit? Absolutely yes. Is it part of the employee compensation earned in a particular year? Absolutely yes. Is it included in national income? Absolutely yes. Should it be included in personal income? No. Answer is no. Why? Because it is not received by the individuals. It is only earned. So simply put, what is personal income is nothing but national income plus income received but not earned. Received but not earned. Something like transfer payments. Minus of income earned but not received. Something like undistributed corporate profits and employers' contribution to provident fund. These are adjusted to the national income so that we can get personal income. Ultimately, people have to spend. People have to buy goods and services. That is economy. And that will be decided upon how much personal income is there with the people. People means individuals and households we are talking. Lot of money is there lying in the corporates. It doesn't matter. That is not going to be directly affecting the consumption of particular people and country. So personal income is different from national income. Even though a particular country has a national income which is very good, still if that money is not going to the hands of the people ultimately, people means all the people, rich, poor, middle class, everybody, all people, all individuals and households. If that is not with the people, then that is not a personal income. So ultimately personal income is that which is nothing but national income plus income received but not earned minus income earned but not received. Adjustments have to be done to national income so that we can get personal income. So we have started with GDP at market prices. Then we adjusted for net factor income from abroad, we got GNP. Then we adjusted for depreciation, we got NNP. Then that too at market prices. Then we adjusted this indirect taxes for obtaining factor cost, which is NNP at factor cost. That is what we are calling it as national income. Then add income received but not earned minus income earned but not received, you get personal income. Is it the money that people spend? Probably, but not also. Why? Because there is still another adjustment to be done which has to be used for computation of disposable personal income. Is the entire personal income possible to be spent by people? Answer is no. Why? Because individuals also will have to pay income tax. So what is the disposable personal income? Simple. There is no big deal here. Disposable personal income is nothing but personal income minus personal income taxes. Then what is the resultant? That is the money. That is the money. The disposable personal income is the amount of money in the hands of the individuals that is available for their consumption or savings. Disposable personal income also does not mean they will entirely spend it or throw it out in the market by spending it. Not necessarily. They will save it or spend it. One of them they will do. But that is what they have in their hand. That is called disposable personal income. What is available for consumption or savings with the individuals. Individuals is an important point here. People, we can call that individuals and households. Households is forming part of individuals only. No? Just a house will not have anything. Household also includes individuals. Okay, you call them people, you call them families, you call them whatever the name. Individuals, whatever the money that is available with them for their consumption or saving in a particular year, that is called disposable personal income. How to calculate it? That can be calculated by subtracting the direct taxes that are paid by the individuals and other compulsory payments made to the government, if any. Usually there will not be many. So only simple thing, we don't have to worry about those other compulsory payments. Only just general definition it is given like that. Particularly what should be deducted from the personal income in order to arrive at disposable personal income is personal income taxes. That's all. So disposable personal income is equal to personal income minus personal income taxes. That is the end of many economic aggregates starting from GDP to disposable personal income. That is a flow. If you understand clearly the concept of each of these words and what is the difference between one and the other, then it is very easier to solve any questions that we will encounter in the examination related to this topic. So I suggest that you write all these things on paper, write the formulae, but just don't blindly by heart it. Remember them, but don't just by heart them. Understand the concept. Where from we started, how is it changing, what is the difference between gross and net, what is the difference between domestic and national, and what is the difference between market prices and factor cost, and what is national income ultimately? That is national income, which is net national product at factor cost. From national income, if you adjust the incomes received but not earned and income earned but not received, you get personal income. From personal income, you deduct personal income taxes, you get disposable personal income. All these formulae you should very clearly remember and understand the concept also. Of course, some of the formulae are given in the product point of view, production point of view, and some of the formulae are given in income point of view of different factors of production contributing to the production process. Ultimately, in whatever way we calculate national income, the answer should be same. And these formulae, before going to the next session where we will solve some questions, numerical questions also related to them, I want all of you to be thorough with these formulae Write them number of times on paper, and you should be able to convert from one kind of aggregate to another kind of aggregate. Let us say if I say I want from NDP market prices, I want NNP at factor cost. You should be able to convert that by doing relevant adjustments. Same way, from any one of them to any one of them, you should be able to do the adjustments. That is possible only if you understand each word very carefully with a conceptual point, not by hearting the names or formulae. But yes, these formulae you have to write number of times so that you test yourselves how strong you are in the concepts of these formulae and test yourselves. So be ready with these formulae, be ready with your understanding and memory of various formulae which we will use in the computational aspects of various problems, you can call them, numerical questions you can call them. That we will discuss in the next session. In addition to extending this discussion from the general formula point of view to the three-dimensional point of view, we will extend that. We have already touched it. Three-dimensional point of view of national income is what? One is from production side, one is from the sales side, and the other one is from distribution side. Or we call it production method, income method, expenditure method. Any of them can be used for computation of national income. So far we have computed using these formulae. Be thorough with them, and we'll continue this discussion in the next session and conclude this unit, very important unit. And if we understand this unit 1 of chapter 1, unit 2 can be easily understood, because already this unit 1 is based on the similar principles which the Keynes has explained in detail. That we will move on to unit 2 at a later stage. But prior to that, we will complete this unit 1 by discussing some more concepts of national income computation and challenges and limitations of national income. At the same time, also solving questions, numerical questions related to computation of national income, very, very important aspect of examination point of view, which we will do in the next session. Till then, take care. Bye-bye. Thank you very much.